morning, everyone. Welcome to our 24/7. My name is Niharika Balia, and I am with you with the area of AFM, that is Accounting and Finance, Financial Management for Bankers. I hope I'm audible to you. Please confirm, as well as clearly visible. Today, I'm following with the particular topic of companies' accounts further. So, I'm going to let you know what is the classification of each and every accounts that we prepare for the particular um, companies. See, if I talk about the companies now, companies have to prepare certain books of accounts, and how do they prepare for the books of accounts, and what do they do in it is something that we'll be talking about today, right? Okay, so let's begin with the particular topic of accounting and financial management for bankers. Okay, in terms of company's account, this is the first question. The first question says, which of the following is not okay? Which of the following is not required to be prepared under Companies Act? Under Companies Act 2013, every company is required to prepare certain books of accounts. And what are the books of accounts there? They have to prepare. Number one, is it the statement of profit and loss account, or the balance sheet, or the report for directors and auditors, or the fund flow statement? See, profit and loss account and balance sheet are a part of the financial performance of an organization, right? So if these two formulate the part of the financial performance, then we will take these two things together. There is a part of statement of P&L as well as the balance sheet. Then report of director as well as auditor is also a part of it, because the auditor's report is prepared by auditor, which talks about whatever he checked in the books of accounts, and director's report is basically an answer to that particular auditor's report. So in this case, fund flow statement is the only statement which is not a mandatory. It is not required to be prepared under Companies Act. It asks only and only for cash flow statement after these three. So the correct answer is fund flow statement, because fund flow statement is not required to be prepared, right? Then comes the next question. Dash appears in the balance sheet under the subhead of short term provision. Among the following, which is a part of a short term provision? Is it basically interest accrued but not due on borrowings? Is it provision for tax, or unpaid dividend, or calls in advance? Go ahead and try and answer. Dash appear in the company's balance sheet. It is there in the company balance sheet, but the point is that it is showed in the area of only and only short term provision. If we talk about the short term provisions, any provisions which is for a period of less than 1 year, we are supposed to pay for that. Is it basically interest accrued but not due? If it's not due, then you are not supposed to pay it directly. Unpaid dividend normally takes time. It's a part of other current liabilities. And then we have the calls and advances. If someone has paid you calls in advance, it's again a current liability. It is that to an other current liability. So in this case, the correct answer for the short-term provision is tax. You Do you really think the government will wait for more than 1 year for the payment of tax? They will never do that. So the correct answer is provision for tax. Next point is, gain on sale of fixed assets by a financial company is shown in the statement of the profit and loss as revenue from operations, other income, both A and B, or none of the above. Gain on sale of fixed assets by a financial company. If we are trying to make any gains from the fixed assets, if I sell a particular fixed asset, for example, I sold a machinery. I do not sell a machinery on a daily basis. It's one of the basic machineries that are required by me, right? That means it is not a revenue from operations, even though the company will be making a profit. But that particular profit portion is not because of the company itself. Na? It's because of a because of some allied things that they did. For example, if I sell books and someday I sell the machinery through which I pack the books, that means I'm selling. You sell an asset, it's a part of other income. It's a part of other income. It's not the main source of income now. So it is called other income. Okay. Here comes the next question, everyone. The next question talks about the net profit before tax minus income tax. Income tax is sorry, income tax is levied on all the companies which are existing, right? There is no specific company where you will find there is no tax there, right? So if we talk about net profit before tax and then you deduct the income tax out of it, what particular terminology do we use? Is it net profit or net loss or GP? That is GP or net loss. And then we can say there is a gross profit or net loss. The next point is net profit or net loss, or we can say none of the above. See, when we are preparing the books of accounts, na, and then when we see this, there is we have net profit before tax. That means you have earnings before tax. The moment you pay tax, then it is no more in the hands of the government. That is in your hand, right? So if we talk about after making the payment of the taxes, whatever is left, it is called the net profit. If it is based upon the production, it's called GP. If it is based upon the net after production, the selling expenses are also considered. Everything related to the selling and production, everything is done. And then we also do whatever we are left with is called the net profit or net loss. Okay. Here comes the next question, everyone. The next question says salaries outstanding rupees 80,000 will be recorded in the balance sheet under. If we have salaries outstanding, what will you call it? Other current liabilities, other current assets, or non current liabilities, or all of the options? Salary outstanding means the amount that the particular we were supposed to pay to him within a period of 1 year, because salaries do not take a lot of time. So that means if we talk about the salaries there, salaries outstanding is basically a liability for an organization but an asset for the person, because if an employee is getting money, he's happy about that, but for the company it's an expense, and we are preparing the books of accounts from the point of view of the companies. So it is a current liability or a current asset or non-current liability or all of the above. When you have salaries is basically an expense, and such expenses are noted down in the form of outstanding. Okay, the correct answer in this particular question is going to be current liabilities, since we are supposed to pay to the people now. So basically, it is other current liabilities. If we are supposed to pay to someone within a time span of less than 1 year, we will note it down as a other current liability. Next question. Preliminary expenses are shown in the balance sheet under the head non current assets, non current liabilities are deducted from the security premium reserve. Do you know what exactly is preliminary expense? Preliminary expenses refers to those expenses which were incurred before the making of that organization. That means before we made the organization whatever it is today, we spent a little money. That is what we call it as preliminary expenditure, that is shown in the balance sheet under the head of non-current assets, current assets, non-current liabilities are deducted from the security premium reserve. Okay, when we talk about the preliminary expenses refers to the expenses which are fictitious in nature over the period of time. It is a part of a fictitious nature, and whenever we are writing off any fictitious assets like this, any fictitious asset is written off in through the security premium reserve. That is, from reserves and surplus we can deduct it. Earlier this was the way, but now they whenever we have to write off any fictitious asset, especially when we talk about the preliminary expenses, or if we are looking forward towards the expenses of right issue, bonus issue, everything is going to be used in terms of the particular point of reserves and surplus. Under reserves and surplus, we will write off all these fictitious assets directly. These are not kept for a longer period of time. As soon as the time is over, they are basically thrown out, right? Because existence of too much of financial assets will also create confusions, right? So if we have to look forward to it, the correct answer is, it is written directly from security premium reserve. What they do is, under the area of reserves and surplus, we have a particular reserve called security premium reserve. From security premium reserve, what will they deduct is that particular amount. SPR minus security premium reserve. Acha, if we talk about the SPR now, let me just write it again for you. It is reserves and surplus. There you have the security premium reserve. From this particular reserve, you can deduct the fictitious fictitious assets like preliminary expenses, right? Now comes the next question. Financial analysis becomes significant because it ignores the price level changes, then it measures the efficiency of the business, lacks qualitative analysis, or is affected by personal bias. Financial analysis is extremely important. Why? Because it ignores the price level changes. This is basically a limitation, that just because we do not see, if I really want to go through any changes now, it is way better that good morning, ma'am. Okay, so when we talk about the financial analysis now, financial financial analysis becomes significant because it ignores the price level changes. Price level changes are not included because inflation causes a lot of problem. So inflation will be removed altogether. Inflation is something that if we keep on adding, we cannot prepare the books of accounts. The books of accounts will become extremely confusing. So ignores price level changes is a limitation of accounting. Second is measures the efficiency of business. So the second point is, it measures efficiency. Number C is lacks qualitative analysis, and D is affected by personal bias. So financial analysis is basically significant or important because it measures the efficiency. Now the point is, it is correct, sir. It is basically, oh, no sound. Am I audible, sir? I can see this proper sound. Correct. This sound, sir. Am I audible now? Okay. So when we talk about the financial analysis, now lacks qualitative analysis. Qualitative part is never there in accounting. So this is not something that makes an importance. It's affected by personal bias. Accounting can be manipulated by us. That's why we need auditors. So technically, there's only one thing that shows the importance, and that is efficiency of the business. Next point, goodwill is shown on the asset side of the balance sheet under what head? Current assets, non current, miscellaneous expenditure, none of the above. See, there was a time where people used to say that goodwill was a fictitious asset, but no more. It is basically, it's been a good amount of years that whenever we talk about goodwill, an it's an asset, and that too a non-current asset which is intangible in nature. We cannot touch it, but the goodwill can be felt now. That's why we will call it a non-current asset. Right? It's a non-current asset. Next point, interest accrued and due on debentures appear in the company's balance sheet under the subhead. See, we are supposed to pay interest and on debentures, and that is something that is due. Is it a short term borrowing, or a trade payable, or other current liabilities, or short term provisions? So, what would be the point there? If we talk about the amount which has become accrued as well as due, we are supposed to pay and it has become due. This is something that we'll be noting it under. Since we are supposed to pay within the next 1 year, it is a part of other current liabilities. Here comes the next question. Interest accrued. We are supposed to pay, but it's not due yet. We will pay it, but not right now, but in the upcoming future. So, what will be the point? Is it basically in the balance sheet as a short term borrowing? Because borrowings are basically loans, and the amount is also accrued. That means trade payables. Then the next point is other current liabilities or short term provisions. If the interest is due or interest is not due, in both the cases, if it is a part of the loan, then it will always be a part of other current liabilities. Right? Next question, which one of the following is commitment? Proposed dividend, interim dividend, unpaid or unclaimed dividend, or dividend arrears on cumulative preference shares? Commitments as well as contingent liabilities, these are not a part of your balance sheet at all. These things have never got that much of importance in the organization that they are a part of their balance sheet. So it's not a part of proposed dividend or interim dividend. Proposed is basically we are thinking that someday we'll put money to use there. And then is interim dividend is basically the dividend that is paid within that particular year already. Then unpaid or unclaimed dividend is basically that dividend that we were calling those people that, sir, your amount is due, your amount is due, but that particular person is not turning up. So it's basically unpaid or unclaimed dividend. And the last one is dividend on cumulative preference shares. Cumulative preference shares means these preference shareholders were assured that in case of loss, if we are not able to pay you, we will pay you the next year for 2 years. So that means your amount is not being lost at all. So it is dividend arrears on cumulative preference shares. So this is where I end my session. I hope it was helpful for you. I was covering the area of company accounts in a detailed format. In the upcoming classes, I'll continue with this particular area. But have you reviewed our portal yet? If you haven't, then it is the perfect time that you can review our portal, because the double validity is going on. What do you mean by double validity? If you want to take up the course for 6 months, you'll get it for 12 months. And that too, if you're preparing for this examination, there you can take up the JIB and CIB Maha Pack. Take one Maha Pack and you are sorted till the time you don't go for the examination. That means you are not only preparing for JIB but also preparing for CIB through this particular course itself. And if I talk about this course, what is the benefit of taking JIB and CIB together? If you're preparing for it, then first of all, 12 plus 12, 24 months validity is there. and at the same time 1100 hours of working, 1100 hours of live classes, 72 test series, 373 videos, as well as 93 ebooks would be available. Plus, if you purchase it, it's not for 12 months, it's for 24 months. For 2 years you have got that period to cover up all the syllabus. Everything that is coming up regarding the JIB and CIB would be available for you, starting from classes, test series, the doubts, or the the books that we have. Then all these things would be there, the notes that we provide to you, so that you can study in a proper manner, right? So but all you need to do is you need to click the area of buy now. You can use the code Y541 and apply it. Here you get a double validity along with the further point of along with the double validity. You have 81% of discounts. If you're preparing for it, it would cost you 10,799. That means less than 1,000 per month. So if you're looking forward to it, then kindly go ahead and hurry up, because 81% discount plus double validity is about to end soon. So go ahead and check it out in our website or in our app for further details. From tomorrow onwards, I'm here. So we'll be looking forward towards a class at 7 a.m. For the CIB, and 7:30 I'm here for JIB. So for all the GIB bankers, please look forward to my class at this point of time. That is